Welcome students. So in the last part of discussion we were talking about the effect of change in the level of current assets. As we have seen that if we increase the level of current assets, your profitability goes down, and if you say decrease the level of current assets, profitability of the firm increases. Similarly, there is a change in the net working capital and the risk profile of the firm, but we can see that current assets are less productive, so we should try to keep the extent of current assets as low as possible in the firm as compared to the long term assets or the fixed assets, because real profit of the firm comes from the fixed assets or the long term assets. Similarly, now we talk about the other side of the balance sheet, that is the liability side of the balance sheet. As we have been discussing, and I told you many times that in India we follow the term structure of interest rates. So in this situation the term structure of interest rates, shorter the duration or the short term sources of the funds which are borrowed for the shorter duration, we have to pay the lesser cost or the lesser rate of interest. If we are borrowing the funds for the long term or for the longer duration, we have to pay the higher rate of interest. So it means if we are using the long term funds for the short term purposes for funding the current assets, our cost of funds is increasing, which is not advisable. So we should do is, as I have told you earlier also, that most of the funds to finance the current asset or to fund the current asset should come from the spontaneous sources and the short term sources. In the very rarest among rare situations, we should use the long term sources of the funds for funding the current assets, because if you have the more say the larger magnitude of the short term funds, the funds coming from the current liabilities to fund the current assets, your cost of funds will be under control. But if you are increasing the extent of the long term funds to fund the current assets, then the cost will go up. Now let us see how it happens. We are going to I am referring you to the same balance sheet what we discussed in the previous case, and case of the to understand the change in the current assets. Same balance sheet we are talking about, and here is the same balance sheet. Earlier we were focusing upon the asset side of the balance sheet, where we had the total asset, that is the fixed assets and the current assets. Now I will take you to the liability side. Here you look at the total liabilities, that is again the 14,000. So $6,000 million is coming from the share capital. Long term loans are contributing $4,800 million, and the remaining, that is $3,200 million, is coming from the current liabilities, right. Now in this situation the extent of current liabilities is 3,200. So how to understand this situation? Again you have to work out a ratio. As we worked out a ratio earlier, that ratio was the current asset to total assets. Now to understand the change in the current liabilities, we will have to start with the ratio, and that ratio now is the current liabilities divided by the total assets, not liabilities, total assets. Current liabilities divided by the total assets, and then we see that how this ratio works out. Whatever the ratio is there. Now for example, we have seen that we had the current liabilities in the original balance sheet is 3,200 and total assets are 14,000. So we can calculate the ratio of this. Now in this case means what this ratio is indicating? This ratio is indicating that if you calculate the ratio here, then the ratio will be 32,000 divided by this. So this ratio is 32 is to 140, the total assets, that is the current plus the long term asset or the fixed assets. So we will have to see that the total assets are the 14,000. Total assets of the 14,000, to what extent they are financed from the current liabilities or from the short term sources of the funds. Short term sources of the funds. How much, what part of the total assets has been financed from the current liabilities? This is we are going to work out with the help of the ratio. And if you calculate the cost of total funds we are going to use to fund the total assets of the 14,000. In this case, let us take the assumptions like we took the assumptions in case of the current assets, we will take the assumptions here in case of the current liabilities also. And we are saying that since short term funds are for the shorter durations under term structure of interest rates, they are cheaper sources of the funds. So, we are assuming that current liabilities or the short term sources of the funds, that is current liabilities, are having the cost of 2%, that is the cost of funds is 2%, and the average cost of the long term funds, average cost of the long term funds is 8%. Cost of long term funds or funds from the long term sources is 8%. We are assuming these two things. Short term funds are at the rate of 2%, available at the rate of 2%, long term funds are available at the rate of 8%, right. Now, in this case, if we use the more amount of the short term funds to fund this total, say magnitude of 14,000 total assets, your financial cost will go down, but the risk will increase, because short term sources mature quickly. You have to repay these funds as early as possible or as quickly as possible, so that risk would be there. But if you see here, what will be the financial cost? We have calculated here. If you look at the presentation, if you look at the say PPT, we have calculated it there, and we have seen that in the original balance sheet, the total cost of the funds is, the total cost of the funds is equal to how much? That is $928 million. $928 million we have calculated, and the net working capital we have calculated is NWC, we have calculated here is that is $2,200 millions, $2,200 millions, that is the net working capital. How we have calculated it is, that is the say the balance sheet, original balance sheet. Here we have seen in the original balance sheet your current liabilities are 3,200 and current assets are 5,400. So, 5,400 minus 3,200 is the 2,200 as the net working capital from the original balance sheet, and there the magnitude of the current liabilities was 3,200 and the total assets are 14,000. And we have on the basis of that we have seen the cost of the funds is $928 million and the NWC is $2,200 million. Now we make a change, like we change the ratio by adding up more amount, that is plus $600 million coming from the short term sources. So, it means now the short term sources will become how much? 3,800 and total assets are 14,000. What is the new ratio? If you calculate the new ratio here, that is 27.1%. This is 27.1%. So, this is the new ratio now, 27.1%. We have increased the magnitude of the funds coming from the short term sources or the level of current liabilities, which was earlier 3,200, now it is 3,800, total assets remaining the same, that is 14,000. Again, now if you calculate the total cost on the basis of the cost of short term funds 2% and the long term funds 8%, your total cost here is how much in this case? That has come out as $892 millions. This is your cost now. Cost has decreased because you have increased the proportion of the cheaper funds to fund the total assets, that is the level of 14,000. And if you see the net working capital, but the negative effect of that is net working capital has come down to $1,600 million. So, it means your liquidity has been affected. Your liquidity has been affected. That net working capital is, that is $1,600 million. It means when the liquidity goes down, when the net working goes down, your risk increases. So, we are increasing the risk by reducing the cost. And now take the next case. If you change the ratio again, you now rather than adding up 600 here, you minus do, that is you subtract the minus 600s, right, that is minus 600. So, how much will be left here? That is 2,800s. You are left with not 3,200s, but 2,800s or 2,800s, and if you have brought it down to 2,800s, it means now the ratio is 18.6%. The ratio is 18.6%. This is 18.6%. This ratio is 18.6%. Earlier the ratio was, original ratio was how much? 22.9%. Then when we increase the contribution from the short term sources, the ratio went up to 27.1%. And when we say decrease the extent of the current assets or funds coming from the short term sources, then the ratio has come down. We have decreased here. So now it is not 3,200, 2,800s, and the ratio has come down to 18.6%. It means when the funds from the short term sources are being decreased, the funds from the long term sources are automatically increasing, because you have to fund the level of 14,000 as the total assets. So now what will be the impact of it? If you are reducing it, short term sources of the funds are being reduced, so what will happen? Your net working capital will increase. But when the net working capital increases, liquidity increases, risk decreases, but at the same time profit also decreases, because the cost is going up. Cost is going up. So if you see here, now the total cost is here 928 it was earlier total cost, and now this cost is going to be how much? Originally it was 928 millions, then it became 892, and now it is 964. Now it is becoming $964. This is the cost 964, and then your net working capital is also increasing. It was 2,200, 1,600, and now it is $2,800 million. It is $2,800 million net working capital has increased. So it means you can see that the impact of this total cost, it is something gone down. It means profit will increase. Here the cost has increased as compared to this level, so the profit will decrease. Net working capital is 2,200s. It went down when we increased the extent of the short term finances. It further increased when we decreased the say contribution of the short term sources of the funds to fund the total assets. So it means there is a reverse relationship. If you increase the level of current assets, your profitability will go down. But if you increase the level of current liabilities, then your profitability will go up, because the cost of the funds will go down. So now we have to take a decision that we should have the optimum level of current assets, we should have the optimum level of current liabilities. I won't say that you maximize the funds coming from the short term sources or from the current liabilities, because that will make the organization highly volatile, highly fragile you can say. And when the fragility increases, so what will happen? Ultimately anytime the firm may collapse, or it may become technically insolvent, and firm may be unable to pay its obligations on the due date. So ultimately it will be called as a defeat, debacle, and it will be the spoiling the reputation of the firm, spoiling the name of the firm, which should not be done. But we should try to find out that the level of current assets should also be at the acceptable level. Liabilities, current liabilities should also be at the acceptable level. If both are at the optimum level, your working capital is managed efficiently and properly. Now here we see that how the total impact of the situation is here. Look at now the situation we have calculated here already. If you look at the PPT, you will be able to find out on this presentation, on this slide, that we have done two things. One is that we have decreased the level of current assets, and second thing is we have increased the contribution of the short term funds or the current liabilities, right? And both the steps taken, both the measures taken by the firm or by the finance department of the firm, you see that they have contributed to the increased profitability, decreased net working capital, and ultimately increase in the say risk of the firm. And if it is manageable, if the firm is going to taking the manageable risk, then there is no harm in it. Now you look at it, that for example when we say decrease the level of current assets, or the ratio of the current asset to total asset was say down, and we decreased the level of current assets by say $600 million, net working capital changed by the $600 million, but the increase in the profits we could find out is by the $60 million. And when you increase the level of current liabilities to fund the total assets by $600 million, your current liability, your net working capital also changed by $600 million, and there is a contribution to the profit by $36 million. So, in total the profitability of the firm has increased by $96 million. $60 million because of the decrease in the level of current assets, $36 million because of the increase in the funds coming from the current liabilities. So, total increase is $96 million, and in this case if you look at new net working capital is $1,000 million. That is the $1,000 million. And then if you look at the say initial profit of the company, was how much? We had 1140 and the cost was how much? This was the profit, and then the initial profit was, cost of the funds was $928. So, the initial profit of the company was $212 millions. $212 millions. And when you profit after decrease in the current asset, that we increased by say 12. When you decrease the current assets, the profit became 1200, and when you increase the current liabilities, the cost after increase in the current liabilities has gone down to $892 million. So, it means there is a total change in the cost by $36 million, and finally you can call it as, if you look at the net effect, of this, you can say that the net effect is 308. Now, this is the net effect, that is 308 million dollars. And this 308 is why? Because we had how much? $212 million already, the profit was this much, and how much you added into this, that is $96 million, and this plus this is equal to this figure, this is $308 million. So, it means net increase in the profit is how much? Net increase in profit, if you see, that is $96 millions. And this has been simply done not by doing anything, not by increasing the production or decreasing the production or anything, by simply changing the composition of current assets and current liabilities. We have added up $96 million more, and your profit, which was $212 million earlier in the original balance sheet, when we change the composition of the balance sheet from both the sides, we have added up $96 million more, and then the profit has gone up from the $212 million to $308 million. But you see, here is one, you can call it as say one limitation of this approach, or one serious limitation I would say of this approach, and that limitation is that we are following here the extreme approach. We have taken the extreme step. We have disturbed the balance sheet from both the sides. From the asset side, we have reduced the level of current assets, and in the liability side, we have increased the level of current liabilities. And in a way, you can call it as, this is the aggressive approach, this is the extremism or the extreme approach, which I think to some extent may not be viable in the real life situation, because either you can decrease the level of current assets keeping the current liabilities same, or you can increase the extent of current liabilities by keeping the level of current assets same. But if you are changing both the sides, it means you are fully securing the sources which are increasing the cost. But if you are managing the cost and you want to maximize the profitability, for that there are so many other things to be taken care of, because by doing so the firm's insolvency can be affected. So, it means I would say it is a extreme situation. So, what we can do is, rather than going up to the extreme situation or following the aggressive approach to minimize the cost and maximize the profits and revenues and profits, let us have a trade off between the two. Means not to follow the say conservative approach, not to follow the aggressive approach. We should have something in between, and that too we call it as the trade off between the say the two sources or the two approaches, that is the conservative as well as the aggressive approach. And once you go for the trade off, what results we can expect, that we will be able to balance the profitability, we will be able to balance the cost, we will be able to balance the risk, because net working capital will be balanced. Now, how to do that? Let us consider another example or the another situation. We have here in this slide, in this presentation, we have a case of a company called as Hypothetical Limited, right, and we have worked out the total short term funds requirement of this company. And if you see the total short term funds requirement of this company, it is given to us here. Look at the slide and look at the total requirement of the funds, look at the permanent requirement of the funds we have given, that is the total funds required, permanent requirement of the funds, and the seasonal requirement of the funds. So, if we have this situation, should we follow conservative approach, should we follow aggressive approach, or should we follow the approach in between? On the basis of these three approaches which we discussed in the say previous lectures, let us apply those approaches here and try to find out the answer to the question, that whether extremism is good, to go for the conservatism, towards conservatism or towards the aggression, or we should have something in between. Now, look at this company. If you look at this company, the total financial requirement of this company over a period of 12 months is given to us. And if you look at this requirement, you would be able to find out that maximum requirement of the company is in the month of October, that is to the extent of 9,000 rupees, and the minimum requirement of the company is in May, that is to the extent of 6,900 rupees. Right. This is the minimum and the maximum requirement. Out of that, we have, means when you say the permanent requirement is, other way around you can call it as the minimum requirement. Minimum requirement is in the month of May, that is 6,900 rupees, and we have assumed that that is the permanent requirement. Short term funds requirement of this company is not going to decrease at all, lesser than or lower than this level of 6,900 rupees, dollars, or whatever it is you call it as. Now, this is the permanent requirement. So, if it is the permanent requirement, every month requires 6,900 rupees as minimum. So, what is the fluctuating requirement? Fluctuating requirement we have worked out over the different months. Say for example, we have seen that sometime it is 1,600 rupees, sometime it is 1,100 rupees, sometime it is 600 rupees, then it is 100 rupees. In the month of May, there is a zero seasonal requirement or fluctuating requirement. And in some month in October, if you see the seasonal requirement is 2,100, which is maximum, right. Now, let us apply three approaches to this particular company in this company's case and try to work out the cost of the funds under the three approaches. If you follow the three approaches, let us follow first of all the conservative approach. Under the conservative approach, say we assume that the total requirement of the funds of the company is, what is the maximum requirement? Conservative requirement means more funds will come from the long term sources, maximum funds will come from the long term sources, somewhere fraction of the funds will come from the short term sources. We assume that the total maximum requirement of this company is how much? That is 9,000 rupees in the month of October, and this is the maximum. And we here take here two assumptions. The assumptions are that the cost of the short term funds is 3%. Cost of short term funds is 3% and the cost of long term funds is 8%, right. Cost of short term funds is 3%, cost of long term funds is 8%. If this is the situation, under the conservative approach, we assume that total requirement, which is a permanent requirement of the company, means the maximum requirement of the company, that is 9,000 rupees or the $9,000, that is coming from long term sources. So, how much cost is going to be there? 0.08. If you see that so 9,000 is 0.08, that is rupees how much? 720 is the total cost of the funds under the conservative approach. We are assuming that all the total funds are coming from the long term sources and nothing is coming from the short term sources, because the approach is conservative. Now we follow the approach, that is the hedging approach. We go for the hedging approach. We talk about the hedging approach, and if you follow the hedging or matching approach, in this approach we assume that there are two sources of the funds. Partly the funds are coming from long term sources, partly the funds are coming from the short term sources. And in this case, how you have to work out is that you have to see here that what is the long term requirement of the company. It is clear that is the permanent sources of the funds, and that is 6,900 multiplied by 0.08. This much is coming from the long term sources, plus you have to calculate here something, that is this is the cost of the long term funds. And if you calculate the cost of long term funds, so it is how much? That is $500 or rupees 500, and we say that rupees 552. This is the cost of the long term funds. Now the cost of the short term funds. Cost of short term funds is we have to calculate. You have to find out now the average short term requirement. And what is the average short term requirement? Total short term requirement is 11,600 divided by 12. So how much is the average requirement? This works out as the average requirement here, it is 966.67 rupees. This is the short term average monthly requirement, and the short term funds cost is going to be how much? Short term funds cost is 966.67 multiplied by 0.03. This works out as how much? This is the dollar or rupees, we would say rupees 29. So the total cost of the funds is going to be how much? Total cost is under the hedging approach is going to be 29 plus 552. This is going to be how much? That is rupees 581. This is our total requirement, that is 581. And here we assume that aggressive approach is not so easy to be followed. So we have calculated the two cost. One cost is, say here, that is 720 under the conservative approach if all the total funds come from the long term sources. And if we are following the matching approach, in the matching approach, say this is this part is coming from the long term sources, this part is coming from the short term sources. This is the cost of long term fund, this is the cost of the short term funds. So total cost is the 581 rupees, million rupees or whatever it is. So this is a cost. So it means when you have increased the proportion of from 0 to some percent under the matching approach, under the hedging approach, your cost has come down as compared to this cost. Now we see again we are following here some kind of say you can call it as say extremes. So can we have a trade off between the two? Let us have a trade off between the two, and we can have some plan that just to find out that what is the trade off, so that we remain more comfortable and any kind of the risk if we are going to take, that can be avoided. So there is we are talking about the trade off between the say matching as well as the hedging as well as the conservative approach, and to calculate the cost under this trade off, let us see here that how to work out this trade off. The trade off will be worked out as say maximum funds requirement plus minimum funds requirement divided by 2. So what is the maximum funds requirement here? 9,000 plus what is the minimum funds requirement? 6,900, and it is divided by 2. So what is now the new requirement we have worked out is, that is a trade off, result of trade off is we have worked out here, that is 7950. This is 7950. 7950. So if it is 7950, which is little more than the matching approach, hedging approach, and less than the conservative approach. This is rupees 7950, right. Now we assume that under this approach, trade-off approach, we will say that this much amount will come from long term sources, LTS, and the balance from the short term sources. Now let us calculate the total cost. Total cost. So cost of long term funds, that is 7950 multiplied by 0.081, and then there is a cost of short term funds. This is how much? The balance. If we have to work out the balance, how to calculate now the balance? If you calculate the balance here, so that balance over a period of time is to be worked out, and we have already worked out the balance over the different months. And if you look at the balance here, that balance is 2700. Earlier the balance, the total was requirement was 11,600 seasonal requirement. Now the seasonal requirement has come down to 2,700, and 2,700 if you divide by how much? 2,700 to be divided by 12. So this works out as how much? That is rupees 225 is the monthly requirement multiplied by 0.03. So this will be one cost, this will be another cost, and if you see the cost here, this cost works out as rupees 636 million rupees, or maybe rupees itself. And if you look at the second cost, this works out as rupees 6.75. So what is the total cost now? This is 642 rupees 642.75. So we have now the three costs, right. One cost is under the say conservative approach. This cost was how much? Rupees 720. Am I right? 720 or 720 millions or whatever it is. Second approach we had, and if you talk about the second approach, under the second approach, which was the matching approach, and under the matching approach the cost had come down to rupees 581. The cost has come down to rupees 581. And if you talk about the third approach, so under the third approach, which is the trade-off approach, cost is little more, that is 642.75. But what is there? This cost is less than this, but this cost is more than this, 581. It is more than 581, right. But here we have many comforts. This is most comfortable. First approach, conservative approach, is the most comfortable, but the discomfort is cost is very high. Though liquidity is also very high, risk is very low, but at the same time profits will also be very, very low. Under this approach, this is a hedging approach. So it means short term sources will, short term funds will come from the short term sources, long term funds will come from the long term sources, and it means in that case net working capital level will be how much? That is 0. It is again a risky situation. Means keeping the net working capital situation 0, it means any time if any short term source of fund becomes due to be paid and any current asset is not convertible into cash, firm is bound to default. So we should have some cushion to have the net working capital. Maybe it is not very large amount, but current assets should be literally more or something more than the current liabilities. So just looking at this risk of having the 0 net working capital, we thought of moving to the third approach, that is called as trade-off approach. So we increase the level of say investment from the long term sources. Rather than investing only 6,900 rupees, we increase the level funds coming from the long term sources from 6,900 to 7,950, and remaining was coming from the short term funds. So when we calculated the cost has little gone up more here, but your net working capital level has increased. There is a cushion, the risk has gone down, though the cost has a little increased, but it is much less as compared to the conservative approach. It is something more as compared to hedging approach, but it is increased cost is giving you the another benefit that risk is under control, it is manageable, and because risk is controlled, manageable, because the liquidity of the firm is at the optimum level or at the acceptable level. So, this is how this is how the level of current assets and current liabilities impact the overall financial cost of the firm, liquidity of the firm, and the profitability of the firm. And we have three approaches, that is the conservative approach, aggressive approach, and in between there is a hedging approach, and finally we can have the trade off out of these three approaches. So, you can call it as trade off is the fourth approach. So, sometimes we say that aggressive approach normally is not possible to be followed by the majority of the firms. So, we are left with the two approaches, conservative approach and hedging approach, and in between these two approaches is the trade off approach, which we have seen in the case of this company Hypothetical Limited, and we have seen how the cost of the funds is changing, risk is also changing, profits are also changing. So, we have to decide from where we want to have the funds, long term sources, short term sources, how much profitability we want to have, how much liquidity we want to have. So, today I will stop here, and the remaining part of discussion we will take up in the next class. Thank you very much.